The dollar isn't just paper with green ink. It's the spine of global trade, the language of oil, gold, tech, even the price of your morning coffee beans. For nearly 80 years, its supremacy has seemed untouchable. But in conference rooms from Johannesburg to Shanghai, a new alliance is quietly asking a dangerous question. What if the world didn't need the dollar at all? That alliance is BRICS: Brazil, Russia, India, China, and South Africa, joined recently by nations from the Middle East and Africa. Together, they control vast reserves of oil, minerals, food, and almost half of the planet's people. They believe the dollar gives Washington unfair leverage, sanctions, transaction fees, even the power to freeze foreign reserves. This isn't the first time America's currency has been tested. After World War II, the Bretton Woods Agreement crowned the dollar king by pegging it to gold and linking other currencies to it. When that gold tie snapped in 1971, the dollar survived by anchoring oil trade through the petrodollar system. Its dominance let the US borrow cheaply, print at scale, and influence markets everywhere. Yet BRICS leaders argue that the same dominance leaves the global South vulnerable. Their answer? Build an alternative payment network, issue loans in local currencies, even launch a new common unit to settle trade, something outside Washington's reach. The stakes aren't academic. A successful challenge would reshape how nations store wealth, price resources, and hedge risk. Gold, rare metals, and crypto could see wild swings. Import bills could shrink for some countries and explode for others. This is not a simple David versus Goliath story. BRICS is big but messy, a patchwork of democracies and autocracies with clashing goals. The dollar, meanwhile, is deeply wired into banks, shipping routes, and trust itself. But the mere possibility of an exit ramp is enough to shake the old order. Over the next few minutes, we'll explore why BRICS thinks now is the moment, what tools they're assembling, and whether the world is finally ready to loosen its grip on the greenback. When you line up the names, Brazil, Russia, India, China, and South Africa, they don't seem like an obvious club. They sit on different continents, speak different languages, and have very different political systems. But during the early 2000s, a shared frustration and a shared opportunity brought them together. The term BRIC actually began as an investment label. A Goldman Sachs economist coined it in 2001 to describe four large emerging economies with fast-growing populations and massive resource bases. At first, it wasn't a political project at all, just a catchy acronym for a portfolio. But as the years passed, leaders in these countries started to see value in turning a banker's shorthand into a diplomatic alliance. By 2009, the global financial crisis had shaken confidence in Western stewardship of the world economy. The dollar and euro still reigned, but cracks were showing. The BRIC nations sensed that they didn't have to sit on the sidelines. They met in Yekaterinburg, Russia, and declared a new partnership to push for a more democratic international order. South Africa joined soon after, turning BRIC into BRICS. From the start, the group wasn't about friendship, it was about leverage. Together, they represented nearly half the planet's population and an ever-rising slice of global GDP. China had manufacturing power and deep reserves. Russia controlled energy and minerals. Brazil and South Africa sat on enormous troves of food, rare earths, and industrial inputs. India supplied talent, tech, and a massive consumer market.
Pool those strengths, and you get a bloc that could, at least in theory, push back against Western-dominated rules. One key ambition was to make finance less dependent on the US dollar. For decades, emerging markets had to borrow and trade in dollars, which meant they were exposed to American interest rate swings and sanctions. BRICS leaders began talking about alternatives, ways to settle trade in local currencies, or create lending institutions where Washington didn't hold a veto. They built the New Development Bank, NDB, in 2014, headquartered in Shanghai, designed to fund big infrastructure projects without the policy strings often attached to loans from the World Bank or IMF. They also set up a contingent reserve arrangement, a joint pool of foreign currency meant to steady members in a crisis. These weren't silver bullets, but they were statements: we can build our own tools. Still, it was clear that any challenge to the dollar would be gradual. Even as BRICS grew in confidence, they kept stacking up dollar reserves for safety, and much of their trade, especially China's, remained priced in dollars. The point wasn't to walk away overnight, it was to create room for maneuver. The club's appeal spread. Dozens of countries, from Argentina to Saudi Arabia, expressed interest in joining or partnering. For resource exporters, BRICS offered new buyers and investment. For governments wary of Western sanctions or lectures, it promised forums where their voices carried more weight. In 2023, the group invited 6 new members, signaling ambitions beyond an economic curiosity. BRICS was becoming a platform for the global South. Yet, the alliance's strength has always been uneven. China towers over the others economically, while India keeps wary distance from Beijing. Russia's invasion of Ukraine put pressure on the bloc, exposing how diverging interests can complicate cooperation. Even so, the members share a long-term incentive to hedge against a system where one currency and one capital city has the final say. By the end of its first decade, BRICS had turned an investment acronym into a standing challenge to financial orthodoxy. The next question, the one that keeps central bankers and commodity traders awake, is how far this coalition can go from talking about alternatives to actually building them. If BRICS wants to loosen the grip of the dollar, it needs more than slogans. It needs tools, institutions, currencies, payment rails, and the credibility to convince others that its system is safe. Over the past decade, the bloc has tested several options, some promising, some still just sketches. The new development bank was the first tangible success. With capital from all 5 founding members, it has financed roads, power plants, and clean energy grids across Asia, Africa, and Latin America. Its pitch is simple: loans without as many political conditions as those from the IMF or World Bank. Yet its scale is still modest, tiny compared to the firepower of Western lenders. For a real shift, the NDB would need far deeper pockets, plus a bond market investors truly trust. Another experiment is settling trade in local currencies. China and Russia already price a growing share of their energy sales in yuan and rubles, while India has explored paying for some imports in rupees. Brazil has encouraged use of its rail in agricultural deals with China. These moves reduce exposure to US sanctions or Fed policy, but they also highlight the biggest challenge: coordination. Each BRICS member guards its own monetary policy, and few outsiders want to hold large sums of rupees or reals unless they're sure they can spend them freely. That leads to the most radical, but also most complex idea: a common BRICS currency. Every few months, speculation bubbles up about a gold-backed unit or a digital token for cross-border trade. So far, officials have poured cold water on the hype. The obstacles are obvious: wildly different inflation rates, fiscal policies, and political priorities. A shared currency would demand tight discipline and a level of trust that doesn't yet exist. For now, the dollar's convenience and deep markets still win. Payment systems are another front. Russia, cut off from SWIFT after invading Ukraine, has promoted its own network, SPFS. China CIPS offers a yuan-denominated clearing platform. Even India has launched domestic alternatives to Visa and MasterCard. Stitching these into a reliable cross-border network could, in theory, erode Washington's leverage over transactions, but only if businesses believe they're fast, cheap, and protected by clear legal norms. The bloc also courts commodities power. Members control huge shares of the world's oil, gas, coal, and rare earth minerals. Pricing those resources in something other than dollars is tempting. It would make the new system more than just accounting tricks. Saudi Arabia's flirtation with selling some oil in yuan is one sign of how resource exporters could shift norms, slowly if enough buyers agree. Still, the road is steep. Internally, BRICS is no monolith. China and India skirmish on their border and compete for influence in Asia. Russia's war creates reputational risks.
Brazil and South Africa depend on Western markets and don't want to jeopardize them. Even inside China, policymakers tread carefully. Their own exporters still prefer dollars for global sales. Externally, trust is the hardest currency. The dollar didn't dominate by decree alone. It earned a reputation over decades as a store of value, backed by deep, transparent markets and the rule of law. Any alternative must persuade investors and traders that their money, contracts, and profits will be safe. That means predictable monetary policy, independent courts, and open capital accounts, conditions BRICS members haven't yet matched. What we see instead is a slow-motion diversification. Countries sign bilateral deals to trade in local currencies. Central banks stockpile gold alongside dollars. New lending bodies nibble at the edges of Bretton Woods. Each step is small, but together they mark an emerging safety net, a world where nations don't have to keep all their eggs in the dollar basket. Yet the dollar's network is massive, and its inertia powerful. For BRICS to carve out real space, its tools must scale, and its members must prove they can cooperate even when their interests collide. Until then, the dollar's throne may wobble, but it isn't falling. The question hanging over every summit and press release is simple. Can BRICS really break the dollar's hold? For now, the honest answer is not entirely, but they don't have to shatter it to reshape the map of global money. The most likely future isn't a clean swap where one currency dethrones another overnight. Instead, picture a layered world. The dollar keeps its crown for big-ticket trade, reserve holdings, and deep capital markets, but regional systems gain ground. A Chinese importer might settle oil deals in yuan. An Indian firm could pay for Russian coal in rupees. African states may borrow from the new development bank rather than Washington-backed lenders. Each choice trims a little from the dollar's reach. Momentum is on BRICS' side in some ways. Their share of world GDP in purchasing power terms has already passed that of the G7. Populations are younger, resources vast, and their trade with each other grows every year. As supply chains reorganize and energy flows tilt toward Asia, the incentive to build finance in parallel rises.
Yet sheer size isn't enough. Without trust and stability, any challenger risks being seen as a niche option rather than a backbone of commerce. China's yuan looks promising thanks to the country's economic heft, but capital controls still cage it. Russia faces sanctions. Brazil and South Africa fight recurring fiscal and political storms. Even if a BRICS coin appeared tomorrow, investors would judge it by the discipline of its stewards, not by headlines alone. There's also Washington's knack for renewal. Past rivals, the German mark, the yen, the euro, each eroded pieces of US influence, but none escaped limits of scale or governance. Every time markets doubted the dollar, American institutions eventually adapted. Deeper treasury markets, stronger Fed credibility, quicker innovation in payments. Unless BRICS offers not just critique but better plumbing, the dollar's inertia will carry it through the turbulence. Still, history shows reserve systems are not eternal. The British pound once ruled seas and ledgers, only to fade after wars and debt. If BRICS nations steadily tighten their financial cooperation, open their markets, knit together payment tech, convince resource exporters to quote in non-dollar terms, the next few decades could see a genuine multipolar currency order. For businesses, investors, and even travelers, that would mean a subtler shift than headlines promise. You won't wake up to find every ATM dispensing BRICS credits, but you might notice airlines quoting prices in yuan on some routes, or African banks giving loans in a mix of dollars, reals, and rupees. Countries on the edge of great power rivalries could keep more of their savings in gold, or in a basket of currencies rather than only US debt. And that, perhaps, is the heart of the story. The quest isn't about erasing the dollar, it's about insurance and choice. A world with more options is one where sanctions bite less, crises spread slower, and developing economies feel less captive to a single interest rate set in Washington. As we close, remember that this debate didn't start with BRICS, nor will it end soon. Money is memory. It carries trust, law, habit, and the weight of trade. Changing that takes time, proof, and sometimes turmoil. BRICS may be planting seeds that grow slowly, but alter the canopy of global finance.
If you'd like to explore how the dollar built its dominance in the first place, the story of oil deals, post-war bargains, and decades of trust, check out our previous video, The Dollar's Power: How the Greenback Became Global. It's the perfect companion to this one, showing the roots of the system BRICS now wants to rebalance.